Hey everybody, Ace here. I'm going to walk you through how to trade a cash secured put on Robinhood. But whatever I teach you here can pretty much be used on any platform that allows you to trade options. So, what is a cash secured put? Well, in its most basic form, it is locking in a price to purchase 100 shares. Obviously, there's more to it than that, but the most simple version is that you're putting up a certain amount of cash to lock in a price to buy 100 shares of a certain stock if that stock were to hit that price or fall below it. Now, if you're familiar with options, you typically buy to open, which means you're buying a contract to open that option. So when you're selling a cash secured put, you're selling to open. You are selling that contract to open it up. Now, there's going to be some similarities to cash secured puts as there are to covered calls, which I did a video on and I'll link up above for you. When you're selling a cash secured put, what you're doing is you're selling someone an option to buy 100 shares of that stock at that certain price. And when you're doing this, you are collecting the premium, the money you're getting for the option, to sell that said person that contract. And that premium that you're getting for selling that option contract is yours to keep forever and ever and to do whatever you want with it. Now, let me show you how you can trade a cash secured put on Robinhood. The very first thing you're going to need to do if you've never traded options before is you're going to have to enable options trading. Now, if you're not using Robinhood, the steps I'm going to show you how to do it on Robinhood is going to be completely different for whatever platform you're using. But when I tried to sign up to do options on Vanguard, I had to fill out an application and submit that in. So check with whatever brokerage account you're using and fill out whatever form they need you to do to enable options trading. To enable options, you're going to have to go into your settings and find options trading or options settings. And then when you go in there, you're going to have to enable options. I have options level 2, which will allow you to buy puts and calls, sell covered calls, sell cash secured puts, and exercise your options. Once that is enabled, the next thing you're going to need to do is have a fat cash stack in your account. And what I mean by this is you're going to need to have a lot of buying power to be able to do a cash secured put. You're going to need to have enough money in your account to be able to purchase 100 shares of said stock that you want to sell a cash secured put with. Once you've done those first two things, enabled your options and making sure that you have enough cash in your account to do this selling a cash secured put, the next thing you're going to have to do is figure out what company you are willing to hold if your option gets exercised and you have to buy those 100 shares. Because ultimately when doing this, you want to make sure you're owning a company that you like holding on to for the long term. Because if you have to buy those 100 shares, you're going to have to hold on to them and either hope that the stock goes up and sell it back for a profit, or if the stock continues to tank, then you're going to be holding on to those shares of a company that you don't really like, and you might just have to take a further loss on it. So for this example, I'm going to use the company TLRY, which ticker is TLRY. So now you're going to find the company TLRY, or type it in at the top, TLRY, or whatever company that you want to do, and you're going to click on trade and trade options. This is once your options is enabled. Now there's a couple things I'm going to go over here if you are new to trading options. First is the expiration date. So you're going to have dates up at the top, March 26th, April 1st, April 9th, April 16th, 23rd, so on and so forth, all the way out to January 20th, 2023. And what you're going to want to do is you're going to want to pick a date that you want to sell this put for. So for this example, we're going to use the April 1st option. And what that is the expiration date, or when that option expires. So Friday, close market day, April 1st. And now we're going to make sure we choose sell put. So you'll have buy put, sell put, or buy call and sell call. So we want to make sure we have sell put on there with the date of April 1st. Next thing you're going to see is you are going to see the share price and the different strike prices. As you can see, the strike price 27, 26, 25, 24, 23, etc. And then you're going to have your premiums, which are going to be listed on the right side. So the premium for the $25 strike price for this cash secured put is $232. For the $24, it is $177. Yes, it says 232 or 177, but options are traded in 100 share increments. So for whatever number you see there, times that by 100, and that's the premium you are receiving. So for this cash secured put, if we were to choose the $25 option and you put in 1, you're going to see you get $232 for selling this one option contract. Not bad. So the next couple things I want to go over are the stats. Let's talk about the bid ask real quick. The bid is what someone is bidding for that contract, and the ask is what someone is asking for that contract. So for this $23 put on TLRY, the bid is $122 or $122 for said contract, and the ask is $145. Next is your volume and open interest. And this is really just going to show how much activity this one contract has. So the higher the numbers, the better off you are selling your cash secured put. So for this example, I'm going to choose the $24 strike price, and I'm going to click on that. And I'm going to look at the bid and the ask, and you're going to see people are bidding $159 and people are asking for $194. So I'm going to choose one contract, and the middle price, which is always selected, is $177. If you get closer to the bid, your contract will most likely get chosen or exercised faster. If you choose closer to the ask, it might take a little bit for a contract to actually sell and for you to get that premium. So for this example, I'm just going to put in 181, which would be $181 in premium that I'm collecting to sell this contract. You need to have enough cash in your account to do a cash secured put, because since you are choosing the $24 strike price, you are going to need to be able to purchase 100 shares of TLRY if it closes at $24 or below by the close of Friday, April 1st. So when you're selling cash secured puts, you're really just collecting that premium and hoping that that stock does not fall below that strike price and close below it. Therefore, you get to keep that premium and your money that you put in for that cash secured put. Now, the premium is going to go up the further out an expiration date that you choose. But the downfall to this is that you are giving a lot of time for the stock price to fall below that said strike price. So for example, if you were to choose a month out, April 30th, and you look at that $24 strike price, the premium is now $445. You're practically making $450 selling that cash secured put, rather than that April 1st date where you're only really making $177. So it's really your choice for how far out an expiration date you want to choose. I like to choose anywhere from 1 to 3 weeks out. Therefore, all of my money or collateral is not locked up for long periods of time. Therefore, I can get in and out of these premiums or trades. Now you might be thinking right now, what's the downside to this? Because right now it just seems like you're collecting free money for just putting up money. So let's talk about what happens when the contract expires out of the money. So for the example on TLRY and that $24 strike price that we chose, if the contract or the stock is at $24.01 or above at close on that April 1st date, it expires out of the money. And what that means is that you get to keep your $2,400 that you had to put up for this contract and that premium that you got, the $177. Therefore, you're making $177 in profit and keeping your $2,400. So as long as that stock price is above that $24, you get to keep the money you put in for that contract and your premium. It's a win-win there. Now let's talk about what happens when your contract expires in the money or you get assigned your options contract. Let's say on that April 1st date, the stock ends up closing at $23.80. What's gonna happen is you're most likely gonna get assigned that contract, meaning you're gonna have to buy 100 shares of TLRY at that $24 mark. Meaning you just bought 100 shares of TLRY at $24, therefore that $2,400 that you put up as collateral will now be exchanged for those 100 shares. Even though the market price of the stock is, let's say, $23.80, you still have to buy it at that $24 mark. But when you account for that $177 in premium, you end up still netting when you really think about it, because 100 shares at $23.80 is $2,380, where you bought it for $2,400. But if you take that $2,400 minus the $2,380, that's really only a $20 difference, but you made $177 in premium. Therefore, you're still up $150 if you were to just turn right around and sell those shares right away at that $23.80 price. Where selling these cash secured puts will get really risky is if you were to buy a cash secured put at a certain strike price and the stock just plummets. So for example, with this TLRY put, if I bought at that $24 mark and the stock just tanks all the way down to $10, I still have to buy 100 shares at that $24 mark when the market price would only be at that $10 mark. Now the last thing we're going to talk about is buying to close your contract. So to open a contract, we sold the put to open it. Now let's say you want to exit that contract. You would buy to close it. So think about opening the door. You sell it, you open the door. Well, the door's forever open, and to be able to close that door, you need to buy to close that door and complete the cycle. So here's an example of why you might buy to close your contract. Let's say you choose a contract that's 2 months out. So for this TLRY contract, we're going to choose May 21st. And you're going to do the $24 one still, which is $565 in premium. Now let's say a month goes by and it's April 30th and TLRY has gone up in price, meaning that contract now that you bought for was $565 is now worth $200. Well, now you can buy to close that contract for $200, meaning that you made $565. Now you're going to pay $200 to close it out, meaning you net $365 still. Not the whole $565, but still $300. But the bonus is your collateral, that $2,400 that you put up doesn't have to sit there until May 21st. You get that back plus the $300 in premium instead of the $565, and then you can just sell another cash secured put again to make more premium and choose a different date out in the future. You could choose that 21st date, or you could choose even further out, another 2 months out, and collect more premium again. There's going to be more of a risk when you're selling cash secured puts versus selling a covered call. But that's why the crucial thing is to make sure you're doing this on stocks or companies that you are willing to own and hold, just in case something like getting assigned those shares does happen, right? If you choose a random company and you're like, hey, this is a really speculative company, but I'm gonna do it because the premiums are really high, and then it tanks, you get assigned those 100 shares for $3,000, $5,000, whatever it might be, and the company keeps tanking, then you're gonna be SOL on your money, and you're gonna be sitting there thinking, well, I either just bag hold this and hope to God that it comes up, but hoping is not a good investing strategy, so then you might end up just selling your shares at even more of a loss, making you really salty on doing this options trading strategy. Whereas if you invest into a company that you know that you're comfortable with holding, then if you get assigned those shares, you can just think, hey, one of a couple things. I can just hold these shares because I got them at a discount and I ultimately know that company is going to go up in the future. Or you can turn around and you can sell a covered call with those shares, which is technically called the wheel strategy, where you cash secure put first. When you get assigned, you keep them, you sell a covered call against. When they sell, you cash secure put again. You can do that. That's an options trading strategy, but it is just crucial to invest into a company or trade options in a company that you are comfortable with holding those shares when assignment does happen. And that is all I'm going to cover in this video, and the things that I look for or I do when I do cash secured puts. But if you have any questions, please leave them down in the comments and I will absolutely answer them for you. If you like this video or learned anything, please just tap that thumbs up button for me and subscribe for more content. And I really hope to see you in the next video.